Hello, everyone. I'm Todd Rosenbluth, Head of ETF and Mutual Fund Research at CFRA. And thanks for joining us for our latest CFRA webinar, this time with TrueShares. We're going to talk about how to select stocks using ESG criteria. We'll move to the next slide to give you just a background on who else is joining me for this presentation that you'll hear from in coming minutes. So Linda Zhang is the CEO of Purview Investments, and Jordan Waldrop is the Chief Investment Officer of TrueMark Investments. And together they're going to talk about the investment process behind one of their ETFs, as well as the case for using ESG within your portfolio. Let's move to the next slide, and I'll give you a greater sense of the agenda we're going to cover. A reminder about CFRA, what we're seeing within the ETF industry. We'll talk about the drivers of ESG growth, talk about how you can use active management to build an ESG portfolio. And then, of course, there'll be disclaimers and information and risks before we get to an appendix. Throughout the presentation, we'd encourage you to ask questions, and we'll get to as many questions as time permits. Let's move to the next slide here as a reminder about CFRA's, how our ETF and our mutual fund research fits in to our lineup with our market commentary, our individual company research. We have coverage of over 1,800 ETFs, and that's powered by our coverage of stocks, both qualitatively and quantitatively. On the next slide, you'll have a deeper understanding of the way that we go about rating our ETFs. It's a focus on the holdings, and we'll talk about the holdings of ESG products in a moment. Our goal is to offer a forward-looking view of the portfolio from a risk and reward perspective, leveraging our team of equity and forensic analysts, as well as assess the risk of the portfolio using past performance and other metrics. Cost plays a role in our ETF ratings, but it is not the sole driver. And as you'll see on the next slide here, we're talking about how important it is that we're independent in our research. Yes, we have an asset manager part of this session, but we don't manage our own money. We don't create financial products. We don't have an asset management arm. We are truly independent. Let's move quickly to the next slide, if I may. And we'll just talk about the ESG landscape. We wrote about this recently on Market Scope Advisor and however else you consume our CFRA ETF research, but we've seen really strong demand for ESG products in 2020. You can see the middle column of year-to-date flows has really been quite strong for iShares, for Vanguard, and for DWS's X-Tracker products. In many cases, the assets are more than doubled based on this year's flows. Looking at ESGU, looking at ESGE, and looking even at ESGV, which is a Vanguard product, has been quite popular as well. On my next slide, I want to also just show you that not all ESG ETFs are the same. We're highlighting Ecoz, ECOZ from TrueShares on this because we're really seeing investor interest from our clients as well as in the broader industry for active management in the ETF wrapper. And the left-hand side of the screen here really shows the value that active management can provide at the security selection level. You can see Apple and Microsoft are much lower weighting in the orange bars of Ecoz than the broader market and ESGU. And you can see companies like Square and Tesla that are much more heavily weighted within Ecoz and Tesla. And we'll talk about why that is when we bring my colleagues on this panel into the session. So let's do that. Let's move forward, if I may, and I'm going to bring Linda Zhang of Purview in. Linda, we'll move to the next slide as I ask you the question of what do you think has been driving ESG ETF adoption this year and in more recent years?
To share with you from our angle how ESG ETF has grown recently. I think 2020 is a year where ESG ETF has grown phenomenally. When you look at the AUM, just within first 10 months, I actually just run a number this morning, the AUM of ESG ETFs just in this country is close to 42 billion. And that's close to 150% increase just this year. So it's quite phenomenal. Some of you might have noticed that ESG ETF also has mega size product. There's one ETF, the top ETF has just reached 10 billion. So I think certainly there's a tremendous amount of growth in this space. I couldn't think of any other subsector of ETFs that can grow 1.5 times just within over first 10 months this year. Talking about drivers, I see huge amount of the flow are driven by investment advisories, and that's a big categories, which includes big asset allocators, platforms such as eVestnet. If you look at the $10 billion product ESGU, for example, 80% of that is coming from investment advisories, including eVestnet, Bank of America Merrill, and BlackRock advisories. So institutional owners are increasingly behind ESG ETF investments. If you look at last year's mega ETF ever launched, they happen to be ESG ETFs. They are actually backed by Finnish insurance companies. So we have seen a global embrace for ESG investment from large institutional asset owners, including Japan's government, Japanese government pension plan, California's employee pension plan, and UK's USS pension. These three alone, they represent 2 trillion combined assets under management, and they put ESG investing at the forefront for their employees' retirement future. So this is quite fascinating. So it's not just the retail, not just the investment advisors, but also it's embraced by institutional asset owners. And, on this page, I like to talk about, it's not just investors are demanding for it. Year 2020 is really a year of awakening, corporate awakening about multiple crises. We're talking about a healthcare crisis, climate crisis, and social equity crisis. Many companies have taken corporate activism like I have never seen before. I think more and more CEOs are embracing inclusive capitalism. Just give you some example that Disney, for example, this is one of our holdings, they actually announced increasing minority-produced programs. I don't know if you've seen Black is King. I watched it in Beyonce's program. This is one of their initiatives this year. And companies who are not considered, a good example of ESG, they got backlash. For example, Facebook got backlash from their corporate clients. Many of them paused their advertisement on Facebook platform in the month of July. So there's a recent study by Citi, actually. The lead author is Donna Peterson. For those of you who are interested in this, for the first time, she has put a number, a tag on the loss of economic activities due to racial inequality to $16 trillion over the last 20 years, because of pay gap, ownership, college education pay gap, education gap, and unequal lending, for example. So this is a great study. So companies are embracing definitely social activism. They see that as not just immoral, but it's also about lost business revenues. What's also very interesting is the climate actions. This year, we have many corporations who made clear announcements, clear plans about becoming net carbon neutral, and way ahead of Paris Agreement of 2050. So Apple and Microsoft have announced net zero emission by 2030, just 10 years from now. And Google has announced something that's very interesting. So they're saying by 2030, they want to become zero carbon emission, not net zero. Whenever you hear net zero, that means companies are still relying on fossil fuel, but just participate in offsetting programs. But Google's announcement is like the biggest sustainable moonshot yet, as said by their CEO. So they're saying 24/7, all the operations will be run on renewable energies around the world. So this is the corporate activism on social equity, on climate issues. It's just unseen. This is a great development. And lastly, I want to, those of you who are interested in our new regulatory reports by CFTC, this is a 200-page report. It clearly has outlined climate risk is a financial systemic risk. So this is, I like to share with you the big climate or big environment, why these are all conducive to ESG investing. So we can move on to the next page. Yeah, this page, before I hand it to my co-manager, I want to touch base on this page, which really highlights our philosophy about ESG investing. So ESG investing is really about, for us, is really about identifying the key industry transitions toward a net zero emission and ESG aligned economy. And so these are not just, the way we think this is important, because not only it's right to do these things, but also they're absolutely consistent. ESG principles are consistent with long-term performance. And here are 5 of the themes, 5 of the 10 themes I can share with you that are currently in our reflected in our portfolio. So we have fossil fuel, the demise of fossil fuel and rise of alternative renewables. We also have a theme that reflect transportation industry's revolution to electrification. And we have another theme that's companies that are enabling work from anywhere revolution and not just work from home. And next one is the emergence of online consumption, not just goods, but increasingly services. And the last thing I want to highlight is a fintech transformation that disrupting the traditional banking industries. So I'm going to spend some time on the first 2. They are the most sort of obvious, but there are lots of stuff that's going on that are presenting tremendous investment opportunities. So we have seen, we noticed that many of the themes are already, we have seen the trends, but the great pandemic has accelerated the changes in these trends. Fossil fuel demise is a case in point. We have seen a shift in demand away from fossil fuel, increasingly to renewable. And fossil fuel industries has been subject to decline in demand, stranded asset risks, investor backlash, and this year, notably, many banks are announcing defunding fossil fuel related projects, and clearly raising the cost of the capital for these investments. And these companies also are subject to rising regulatory risks. And on the other hand, we have seen tremendous growth in renewable energies. When you have technological progress, corporate activism, and changing consumer behavior, plus policy changes, that's usually a good formula for a rise in the industry. So just give you an example, in solar industry, because of cost collapse of solar, which is only about 1/10 of what it used to be in terms of the equipment. So cost collapse and tax credits have become a huge support to the rise in solar demand. In the last 10 years, there's actually a 50% increase every single year. And that translates into 250,000 jobs, solar jobs. Is actually the most jobs in all renewable energies. And the policy support is very interesting. So globally, we have seen China recently announced 2060, right, where the whole economy is going to go to net zero. And in the US, with the pending election, it's very interesting that if the election poll is any indication, and we're likely, is accurate, right? We're likely to see $2 trillion climate spending by the new administration, which will be a huge boom to renewable energies. And other things, green transportation that has happened. Many of you probably hold Tesla like we have. We have held Tesla from the very beginning because we really believe that the transportation revolution is in full gear in terms of electrification, in terms of the sharing and autonomous driving, and increasingly the long range batteries, which have seen the cost declining. Recently, California just became the first state that announced a ban of fossil fuel-based vehicles 15 years from now. So California is joining 14 other countries which already announced such ban. So we see electrification of transportation industry is a huge long-term investment trends. Similarly, so in terms of investment, what does that mean in investment? We do have exposure to Tesla. We have exposure to Uber as well. And in terms of alternative energy, Tesla is, with their battery day announcement, is also a big player to the battery, which increasingly will be related to renewable energy. So in our portfolio, we have zero exposure to fossil fuels, zero exposure, including coal company and the big oil companies. But we have 3 exposures to solar and renewable energy plays. Work from home, we do have quite a few positions in particular technology firms that are enabling work from everywhere. And similarly, we have more than benchmark exposure to online services, online e-commerce, and finally in fintech, we have companies that we actually only hold one traditional financial bank, and most of our banking exposure has to do with companies like Square, like PayPal, Intuit, right? They are at the forefront of digitization, digital payment in banking industry. And the other subsector of financial is, we also overweight companies who are in the ETF ecosystem. I didn't put it here, but that's one of our sub-themes in financial sector. So we continue to believe that ETF will shake the asset management industry. So these are some of the thematics, and we overweigh those themes in our portfolio. So next, on next page, I would like to turn it to my co-manager, Jordan, on how we actually build this low carbon and ESG active ETFs.
Thank you, Linda. Well, one of the things that we did when we first started putting this portfolio together is we were looking at the ESG space, and honestly, one of the most quantifiable aspects you can look at is carbon intensity. And we started looking at some of the larger players, and you can see on this chart here that SPY, the S&P 500, has about 170 tons of carbon emitted per $1 million of revenue. These other large ESG portfolios reduced that a little bit. And so we started doing a little digging, and you can see how we put our portfolio together there on the left with about 39 tons of carbon emissions per $1 million of revenue. And it's not simply just removing energy. we actually have a process in which the first step that we actually take is we kind of remove the worst emitters from every sector. And, it really only removes about 15%, 17% of the names in the S&P 500, but has a dramatic impact on the carbon footprint. In fact, if you were to just take that 85% of names across all sectors and do the S&P 500, you drop that S&P 500 emission from 170 down to 50. And so what that tells me is that a lot of these other portfolios are just kind of greenwashing, if you will. They acknowledge at ESG, they're maybe putting some things in place, but the real exposure to carbon is disrupting your industry, taxes that might be happening, having to switch over to other sources of energy. Those are risks that those companies face, and we actively remove those risks from our portfolio with our process. So the result is a portfolio that is significantly reduced carbon intensity. And if you go to the next slide here, you can actually see some of our process. And one of the things I would highlight in this process is that our goal with this was to really merge ESG and the evaluation into the fundamental and intrinsic value of assessment of the companies that we're looking at. So our investable universe is the S&P 500, Bloomberg 500. There's a couple names that might get thrown in as well because they are both large enough and important from the process that we're looking at. Then we filter out the heaviest polluters. Some of the names that are eliminated just strictly because of their total greenhouse gas emissions. Others are eliminated based off of their relative pollution from their peers. And then that gives us our working base of names that we really start to dig in on the ESG process, which I'll let Linda kind of dig in on that a little bit.
Let me take you quickly through, how we actually conduct our ESG research. This really entails two-part, if you will, which is, as suggested by step 3 and 4. So step 3 serves as a quick way to identify champions. Who are the really good ones, right? On E and S and G. And step 4 is more about a deep dive. We actually go into individual metrics to examine these companies. I call it fundamental ESG research. So on the systematic portion of it, we do rely on multiple source of third-party rating companies as our initial screening process, just to quickly identify who are the really good ones and get rid of the bad ones. And here, we actually do not believe the ESG overall score approach. To me, it's like you add a male and female, right? I don't know if it's a good analogy. You just don't get much. A company like GM could have, this is one example. GM is rated very favorably by at least 2 of the top 3 ETF rating agencies, but it failed on being a leader in transportation's transition into into EV future, right? So what we do is we actually separate E, S, and G, right? We screen them on individual basis. We basically set up different hurdle rate based on which industry this company is in. For dirty industries and sectors such as energy sector, utilities, materials, and industrials, we tend to set E score a bit higher than others. So we really look at what categories are more material to the particular sector. Similarly, for technology firms, shareholder structure, the governance is very important, and we would set higher standards on, for example, on the governance, where board independence, voter structure, different voter structure, as well as in data security, right? Those governance issues are much more important. But The next step is where we really identify or save. In many cases, we save companies, because certain companies like Tesla, may have a low rating just because of lack of disclosure. Square, right? Some of the newer companies, they just don't disclose as much. So you really have to. So they get poor ratings from many companies. So what we do is we actually go into company-specific data, not just data, but fundamental research, right? To save what we call champions in industry transitions. So what we do is, we have identified these trends, industry transition trends, like I discussed. I gave you 5 examples, right? Currently, we have about 10 going on. And we really ask what a material, right? What are the metrics, the material that I will pay more attention to? For example, in utility, remember our fund is not a tech fund, right? It's we literally invest in all the sectors, with the exception of traditional fossil fuel, but then we invest instead in renewable energies. So for example, in utility, one of the metrics we look at is percentage of electricity coming from renewable sources versus fossil fuel. And that highlights to a couple of interesting companies for us to continue to explore. Currently we only have one in our portfolio, and there are a few others that we're exploring pending on the election results. Right? And so that's how and then once we have done both systematic screening as well as in-depth fundamental research, we come up with a list. Right now we have about 75 names. These 75 names, I think about a quarter of them are the true champions in leading industry transitions. So
go to the next slide. You can see that we start a process with, it's kind of ongoing throughout this. It's investment analysis. One of the things we really wanted to do with this, we didn't want to just, as I said before, greenwash our portfolio. We wanted this ESG analysis to be fundamentally integrated into our investment analysis. And so, we use a return on capital employed method. It's a sector by sector evaluation that allows apples to apples comparisons across sectors. We establish relative value and quality metrics. We incorporate ESG risks into our intrinsic value methods. And we end up with, we do have portfolio preferences. We want these high return on capital businesses. We want high barriers to entry, experienced management, good opportunities for reinvestment, low debt. But the end of the process, we have basically scores on carbon emissions, ESG, quality, and relative value. And, Linda will have identified champions. Those tend to be hitting those categories, but the rest of the portfolio is built with preferences towards those categories. And the result is higher overall ESG scores as far as by third parties, lower overall carbon footprint, and better overall, we feel, return profiles for the companies that we're invested in. And so if you go to the next slide, you can actually see, we have our top 10 holdings on the right here. That's what's, the official list or whatever. But one of the things that really differentiates us is what we refer to as our top active overweights. And that's on the left there. And that's the difference between us and the S&P 500. And you can see, as I believe Todd highlighted earlier, our top active underweights are names that are, significant positions in the portfolio, honestly. It's just that relative to the S&P, we haven't taken the exposure there as we have, as the S&P would have.
Yeah, Todd made a very good point. He observed with some of the leading ESG ETF products, the big, the FANGs company, the big tech companies can add up to almost a quarter of the portfolio. But with us, those represent just a little over 10. But if you look at top 10, and those happens to be our most underweighted among the 75 names we currently have. And if you look at the first one, the top most active weighted, right? They really reflect some of the themes I've discussed. Square is fintech, right? Tesla, that's our both hitting both first two, green transportation and renewable energy. Enphase is renewable energy. And beyond meat is one of the things I didn't discuss, which is, the food industry transition into more plant-based, right? So an EA is, is a online gaming, reflecting e-commerce and that theme. So I think that's pretty much the portfolio that you see, And next page, I think we have one more page that's just some fun descriptions. Anything to add on your part, Jordan? I think
one thing I would highlight here, yes, we do not have a big an energy stake at all. As Linda has highlighted, we have other energy exposure. The energy positions, that kind of is a perfect example of what our decision-making process reflects. The energy companies in the S&P 500 are all carbon-based. That's fine. That makes it difficult from us from a perspective of ESG, but that's fine. They also face fundamental problems. Fracking has changed the dynamic for oil. Demand for fossil fuels is problematic. I mean, basically it's become much more of a commodity than it was historically with fracking. You don't build oil fields out in the ocean anymore, and so there's a long-term structural problem facing the industry, and it means that all of them have sunk assets and maybe valuations that are questionable, and it makes it difficult for us to look at that from a value perspective or from an ESG perspective that makes sense. So that's just something I would highlight.
So for the interest of time, I don't know if maybe it's time to take a look at if we have any question from the audience. Tom,
that would be great. Yeah. So we'll move ourselves through the disclaimers and disclosures, and a couple of questions came in, and folks, please continue to submit them. So Jordan, let me start with you on this. What we didn't touch on, and we don't have a slide on, but we noted in our research piece is that Ecoz has been outperforming not only the S&P 500, but and many of the broader ESG peers. It's up, I think, 30% roughly since inception. That's about 1,000 basis points better than the S&P 500. Do you attribute that to the lack of energy exposure, or are there other drivers?
It's not energy. Energy is a contributor. I estimate that of that 1,000 basis points, about 1.5% has been due to not owning energy. The rest of it has been more about selection and the champions and to be honest, also the types of names that we own. If you actually look at our attribution from the last quarter, last quarter the fund outperformed by about 4.5%. About 80 basis points of that was energy. So it's pretty clear that not owning energy has been a benefit, but it hasn't been the driver of that outperformance. The driver of that outperformance has been the opportunities that these companies have in front of them. The changes in energy, the changes in renewables, the changes in fintech. These opportunities have they're green fields, as you would say, with great opportunities for growth, and that's what's been driving the growth of these funds.
Thanks. So, Linda, I'll put the second question to you. How do you envision investors, advisors would use an ESG product like Ecoz in their portfolio? Many of our clients are using broad S&P 500 based products as the core. How do you envision this, either as a complement or as an additive?
Yeah, I see Ecoz. This is a well diversified play, so it can definitely be used as I call it deep impact core. So you should definitely be part of your core, but with bigger impact. And you can see, our approach is quite different from other products, and our approach, make sure we're just unique. So I think many advisors or investors can think about, I think you spend a lot of time thinking about asset diversification, right? And I would say you may also want to think about manager diversification. Don't just hold the most plain vanilla product as your core. Think about these deep impact core, deep impact product as part of your core. And I know some of investors are really scratching their heads. How can I contribute to climate change, to help with fighting, climate crisis? And there are many ways of doing that. But one of the most effective way to do that is through decarbonizing your portfolio. And I think Ecoz offers, as far as we're concerned, the only game in town, with carbon intensity so light, yes, yet with a risk profile, risk return profile, very similar to large cap core. And this year we just, because most of our themes are really accelerated by the pandemic. So the long-term thesis actually work really, really well. And we believe, our approach can generate competitive long-term performance, and at the same time, making a better impact on the environment and on our society.
Thanks for that, Linda, and Jordan, thanks for you on the prior question. I'm going to move us to the next slide and thank the audience for the questions that came in, and to highlight both a webinar that we're doing in November. We're taking a bit of a break with our upcoming webinars, but we hope you take a closer look at this webinar, which is going to focus on the retailing space. We're going to have some of my equity analyst colleagues talking about how COVID-19 has changed how and where people shop, the winners and losers. It's an outlook for the holiday shopping season of 2020, and you can see the registration link that's on the page. We've touched on the research that we at CFRA have, both covering this ETF, which happens to be a 5-star rated ETF, and the thematic content that we've written about the ESG landscape, who the players are and how they're different from one another. That content you can find on MarketScope Advisor. If you're not currently seeing our thematic research, please check that out. You can get trial access to it to learn more information. And with that, I'm going to just thank my audience and particularly thank Linda and thank Jordan for joining me on this really informative discussion about ESG investing, how you have stocks to build a portfolio, and how our clients can use ESG portfolios in their broader lineup. So thanks a lot for tuning in, everybody. And with that, there'll be a survey. We'd welcome your feedback. It'll pop up in a minute when I finish talking. Please let us know what you think. We'd love to hear from you. Have a great, wonderful day.